Thank you for joining us on Avalara's presentation on sales tax changes in Louisiana. We appreciate everybody taking the time to join us because we know how busy everybody is and how important it is to understand what states are doing. If you spend any time and you spend time in the sales tax world, or the state and local sales tax world, or the SALT world as it's officially called, you understand that the actions by individual states can radically change your tax compliance and the tax compliance of your partners and your clients. So we'll get started here, and it's just right at the top of the hour, so we might wait just another 30 seconds or so. And in that, I'll just give my introduction there. I need a new picture because I have shaved off that tacky beard. Probably should have shaved off everything, but I didn't. So I'm Director of Government Relations for Avalara. Been with the company 3.5 years. Before Avalara, I was with the thing called the Streamlined Sales Tax. It's still in existence. It's a 16-year-old association of state governments trying to make sales tax more uniform and less complicated for the benefit of retailers. And I was its first executive director. Prior to that, I spent 10 years as the director of the South Dakota Sales Tax Division, which is the majority of my sales tax experience comes from that, as I was trying to administer what is one of the most broad sales taxes in the United States. South Dakota, like Hawaii and New Mexico, taxes everything. All products, all services, unless there's a specific exemption. And in addition, when I was there, we had 215 cities with a sales tax and 4 tribal governments with a sales tax. And then we had this really funky tax on construction services. And I was the administrator responsible for all that. A great job, actually. Learned a lot. Then prior to that, I spent 12 years doing research and legal writing for the South Dakota Legislature. I was the South Dakota Legislature's tax specialist. In those days, the only thing I understood was property taxes, because that's the only tax anybody cared about. All the other taxes were fine. Everybody hated the property tax. So today we're going to talk about Louisiana's budget woes. We're going to talk about sales tax changes, other tax changes, pardon me, and we're going to see just how interesting a state legislature can be when they feel they have to do something radical and they don't know what radical means. So let's talk a little bit about Louisiana. What happened this year in their budget woes this year isn't new. They've had bad budget years for several years, and they put band-aids on their budget for several years in a row, and it just finally got to the stage where there just wasn't anything they could do other than do something serious. Brand new governor this year, elected, comes into office in January. First thing he does is call the legislature in special session. Louisiana is one of those states whose legislature doesn't start until April, and so he felt he could not wait until April, given the size of their budget deficit. And the budget deficit at that time was $900 million for the fiscal year he had. So this was in January. He takes office in January. There's 5.5 months left to go in his fiscal year. He's got a $900 million budget that he has to resolve before the end of June of this year. In addition, at the time, they were projecting a $2 billion deficit for 2017. So February and March, the legislature and the governor argue and argue and argue, and they spend 25 days arguing about what to do, and there were all kinds of proposals thrown out there. Everything under the sun was out there, and what they settled on is really, I don't want to say it's typical of a legislative body, but legislative bodies often are not revolutionary. They're evolutionary. they tend to take what they have and make it a little bit better or change it a little bit. It's an extremely unusual the opportunity when a state legislature makes a radical 180-degree change. It's just almost unheard of. So as soon as the legislature and the governor had agreed on what to do, took him 25 days to do it, the governor said he was going to call another special session. And I just read an article in the paper today about what his legislature is doing. Their normal session has started, and he's not thrilled with what they're doing in the normal session, and he's already warned them again that if they continue on the way they're going, as soon as they're done, he'll call them back in special session to undo what they've done. It's going to be some fun times down there in Louisiana. And of course, those people that are opposed to taxes or opposed to tax changes, or maybe just even opposed to these tax changes, would actually like to see things settle a bit, to see if what they have done so far actually has the effect that they thought it would have. And there's lots of theories and points of view about how tax changes impact the way you and I behave, and sometimes it's true and sometimes it isn't true. So let's put a little perspective though. So they've got a bad budget. They've got a horrible budget. And they've had a bad budget for a couple of years. Well, this maybe isn't their fault. 2005, Hurricane Katrina, effectively destroys New Orleans. 3 years later, we have a worldwide recession that effectively destroys all finance all over the world for the better part of 3 years. So you have a devastating hurricane in your largest community, and then you're part of a worldwide recession. And then, in 2015, the price of oil, coal, and natural gas just collapsed. So maybe these things are not, maybe, and if you look around the rest of the country, there's frankly a number of states that have budget deficits, more than I think people would believe could happen this far out of the last recession. In the last recession, every state had a budget deficit, every state but North Dakota. And when the recession ended, most economists thought, okay, states will slowly crawl out of the recession. They'll slowly crawl back into normal tax revenue and crawl back into normal expenditure patterns. And there's states that just haven't done that yet. And then, on top of that, you throw in the worldwide collapse of oil and coal and natural gas prices. So oil averaged $99 per barrel in 2014, fell to $52 in 2015, and when it got in January of this year, it dropped down to $30. Actually, I think it got down to $27 at one point. It's back up there now. I saw the other day that it's back up over $50, which will certainly help all those states, including Louisiana, that depend upon the price of oil. In most states, severance taxes, and that's the tax that's the severance is the word that is used to describe the tax placed on things extracted from the earth. So whatever, and there's severance taxes all over the United States for all different kinds of things. Oil and gas and coal are, the three products most often taxed for the severance tax, but there's gold, there's silver, platinum, gravel, sand, trees. There's in trees, maybe not a very good severance tax, but it's kind of a severance tax. Just about anything you can take out of the soil is subject to a severance tax in some state. On average, it's taxes from severances, severance taxes make up 0.2% of a state's budget. That's nationwide. In Louisiana, it's 16% of the budget. And there's 6 other states where it's roughly 16% of their state budget. And if you look at the states whose economy has just taken it, in the stomach here with the price of oil falling, it's those states whose tax revenue is heavily reliant on severance taxes. Just a little more perspective here. Louisiana is one of only 8 states in the country. You take out those 8 states, they're 90% of all this country's severance taxes. So that other 10%, the $1.8 billion that's not in those 8 states is spread over every state in the country, including California, big states, large Kansas, where there's, Kansas and Oklahoma, where there are, Oklahoma's in one of those 8, pardon me, but Kansas and Michigan, really big states that actually have a fair amount of severance going on. Okay, over-reliance on severance taxes. Oil and gas as a share of their gross domestic product is 7.5%, 1.8% for the entire U.S. Severance tax collections through September 2015 were down 22.9%, and it got worse the fourth quarter of 2015, and it stayed worse the first quarter of 2016. Other taxes, and this is another slide that gives you perspective on Louisiana's tax structure. So severance taxes through September 15 are down 22.9%. Other taxes, all their other taxes, were up 2.5%. So you have all the other, and Louisiana has all the normal taxes. They have a sales tax, they have a corporate income tax, they have a personal income tax, they have all the normal taxes, and if you want to consider them normal taxes, that every other state in the country has. But because they're so reliant on severance taxes, even though all their other taxes are up 2.5%, total tax collections are down 3.2%. This is for severance taxes. This is similar to what you see in New York and California on personal income taxes. Both California and New York have their personal income taxes heavily weighted toward capital gains distributions, taxes on capital gains. And when there's lots of capital gains in New York and California, there's lots of personal income tax being collected. When there's none, there's none. So their solution, what did they decide to do? Well, they continued their spending reduction. They had been reducing spending over the 3 or 4 years before that when their budget didn't match their revenues. This time they reduced spending by $160 million. They used $400 million of one-time money from their rainy day fund and their British Petroleum settlement. Remember the big British Petroleum oil spill? Well, BP gave all those states lots of money. And in this case, Louisiana decided to use some of it to balance their budget. And any good economist is familiar with state revenue and expenditures will tell you that it's not a particularly good idea to be using one-time money if you have a long-term budget problem. And then they increased taxes by $300 million for this fiscal year and $1 billion for the next fiscal year. Now remember, when they went into special session, they were projecting a $2 billion budget deficit for next year, and their tax increases were only $1 billion. They are going to, unless the economy turns around and the price of oil is back up, so that helps them, unless things radically change down there, they're going to go back to the drawing board. So what they did is, I said earlier that that state legislatures rarely do something revolutionary. They always do something evolutionary, which means there's little tiny changes around the edges. They nibble. And maybe they'll make a big nibble, but it's always a nibble related to something they've already got. So they have a state sales tax, and on April 1, they increased their sales tax by a penny. They call this a clean penny, which is kind of an frankly, I'd never heard of this phrase until I saw that used in the press by the politicians down there. And I'd never heard of this because I'd never actually imagined a state legislature doing what they did. It's clean, and it's kind of an odd, I'm sorry, it'll take me forever to acclimate to the use of that word, because they also suspended almost all their sales tax exemptions. And I never thought of pennies being clean or dirty when it came to taxes. I never thought of a sales tax exemption as making a sales tax penny unclean. That's the concept that I'm struggling with. In addition, so they did that, and so they passed this 1 penny sales tax increase and said that the overwhelming majority of exemptions in Louisiana aren't exempt from this additional penny. In addition to that, because their budget was so bad and it took them until the end of March to get this accomplished, they also suspended all those same sales tax exemptions from all their sales tax for April 1 through June 30th. So you have a state sales tax that goes up by a penny on April 1, and when it goes up, all but a select group of current exemptions go away on that 1 penny, and then for 3 months, April, May, June, those same exemptions that went away go away for all the state sales tax. I'm and I've been studying state funding and state taxes for 30 years and never experienced anything like this. So these temporary sales and use tax reduce over time. So it's 5%. State sales tax is 5%. Sales and use tax. Remember that there's a use tax out there, and if you're a buyer and you're buying from somebody who's not charging you sales tax, you owe the use tax. All of those, both those taxes go up on April 1 to 5%, and then they reduce over time. And the additional one goes away eventually. The additional one. So, like I said, from April 1 to June 30th, July 1, temporary suspension applies to the entire sales tax, not just the increase. On July 1, the temporary sales tax exemption suspension ends for the whole sales tax, but remains in place for the new tax. Many normally exempt products and services will be subject to a temporary tax, even though they were exempt from the previous tax. So on July 1, on March 31st, you were exempt from the sales tax. On April 1, the sales tax rate that you pay goes up by a penny, and you're now subject to sales tax. And on July 1, you still have the 1% sales tax increase, but you're only subject to that 1% increase and not the rest. There's only 65 products and services that they specifically excluded from this exemption suspension, and they list them. Any product or service that was previously exempt that isn't on the list of 65 is taxable, and which is a little unusual. No, that's not true. That's very typical because that's the way the sales tax works. In a state like Louisiana, which taxes mostly tangible personal property, so they have a statute that imposes a tax on all tangible personal property sold in the state except that which is specifically exempt. Then they have another statute that specifically lists a number of services that are taxable. They don't tax many services, but they have some. So it is normal that if you aren't on the list of 65 that you're going to be taxable. It's just, that's the way it is. Where it's confusing is that their sales tax, their general sales tax exemption for services, they didn't touch that. So just because if you're a lawyer in Louisiana and you look at this list of 65 and you know they repealed what they say were all exemptions, which they didn't, you might think, well, I'm a lawyer in Louisiana, I'm not on the one of the 65, am I now subject to sales tax? Well, no, because they didn't touch that sales tax on services exemption. The products and services exemptions that they continued are mostly those used in manufacturing, agriculture, healthcare, or those that are otherwise impacted by interstate commerce. One of the things that a state legislature needs to think long and hard about when they're getting ready to change their sales tax is how easy it is to purchase that thing that they want to tax outside the state. I was part of a sales tax broadening experience in South Dakota where the legislature wanted to tax travel agents. Seems like a relatively innocuous thing. And they also wanted to tax stockbrokers. A little bit odder, from a tax perspective. And both those industries came in the legislature and said, if you do this, you will kill us, because you simply pick up, in this days, you simply pick up, and this was a long time ago, you simply pick up the phone and you call your travel agent in Minneapolis, or you call your travel agent in Denver, and they do exactly the same thing for you as I used to do for them, but I won't be able to do for them because you make me charge sales tax. Of course, now the internet has changed all that. Everything now is easy to buy outside of a state and not be charged sales tax. So it's the whole concept of interstate commerce is really getting kind of fuzzy. So examples of the things that were exempt and continue to be exempt: food, groceries, natural gas, electricity, and water, installation charges, used motor vehicles purchased by members of the military, which I added that, and like I said, there's 65 of these, and I only put 4 of them in there. And there's a list out on the Department of Revenue, Louisiana Department of Revenue's website of the 65. I put that one in there because that one's I thought was a little unusual. I know there are lots of states that do good things for our members of the military, but used motor vehicles, interesting. So all the sales tax changes expire after 27 months. That's 27 months from April 1. So 3 months that remained in this fiscal year. The fiscal year for a state, in most states, pardon me, most states is from July 1 to June 30th. There's a couple states that do it annually, and a couple states that follow the federal fiscal year, which is October 1 through September 30th. But in almost all the states, their fiscal year is July 1 through June 30th. So you count the 3 months left in this fiscal year, April, May, and June, plus 24 months in the 2 years that this thing remains to get to 27. And the temporary tax things slowly go down. Okay. What are some of the things that are taxable in today that are taxable today for the entire state sales tax, that on July 1 will be taxable for the tax increase? And an interesting collection of exemptions. And if you ever spend much time looking through a state sales tax law, looking at the exemptions can be a very entertaining and educational experience. Sometimes you see the effect of good policy. Sometimes you see the effect of good lobbyists. And sometimes you have no idea why in the heck this thing is exempt. Or why, frankly, when you look at what they tax, why they tax something when there's something very similar to it that's exempt. So just quickly go through these. Construction material purchased by Habitat for Humanity and many like organizations. Louisiana law includes many entities and organizations that are named specifically in the statute as being exempt from the sales tax. So that exemption, construction material purchased by these entities, it's all taxable. Purchase of utilities by approved steelworks, blast furnaces, coke ovens, or rolling mills under certain specified conditions. An odd thing for them a natural thing for them to exempt, because utilities are part of the manufacturing process, and if you're going to exempt, in some cases they're an actual raw material. If you're going to have a manufacturing exemption, or you're going to exempt raw materials, utilities is a relatively commonly exempted thing. Sales and services used in the fabrication, modification, repair of rail rolling stock. There aren't many states that tax rail rolling stock. I know this because South Dakota does, where I used to work, and it was a very unpopular thing to tax because it's really easy to pick up that rail car, roll it into the next state, and have it repaired there. Catalogs distributed in the state free of charge. Okay. Most states tax that. Louisiana didn't. Today it's taxable. Tickets to dance, drama, or performing arts performances sponsored by domestic nonprofit organizations. That's a fairly commonly exempted item. Never quite understood why a professional performing arts performance would be subject to sales tax. No, that the performing arts performance conducted by a nonprofit would be exempt when the exact same thing conducted by a for-profit would be taxable. That's sales tax theory that doesn't make any sense to me. Cable television installation and repair services, that's usually taxable. So that's interesting that they exempted it. Amount paid by radio and television broadcasters for the rights to broadcast film, video, and tape. Very, very unusual thing to tax. If you think about what makes up a television broadcast, and if you were going to tax, let's say you were going to tax the outcome of a broadcast, you're going to tax the broadcast. Like television, $25 a month to watch ABC. Well, you're buying the broadcast of ABC for $25 a month. Fairly often the states will tax that. They tax the $25, but they would exempt the inputs. And the right to broadcast is clearly an input that goes into making up the broadcast. That is a integral and component part of that television broadcast. That's an odd thing to tax. Restorative materials used by dentists. Once again, dentists are, I presume, dental services. I know dental services are exempt from sales tax in Louisiana, and it is not unusual for states that exempt services to tax some of the inputs. I'm not sure what restorative materials actually are, but if it's the kind of thing that walks out in a patient's mouth, that's maybe kind of an odd thing for someone to tax. Suspension of exemptions and exclusions goes away for the first 4 cents of the state sales tax, or first 3 cents of the state sales tax, but stays in place for the remainder. And stays in place for 24 months. So what other things did they do? Other sales tax changes they did. They imposed a state tax of 2.5% and a local tax of 5%, or 0.5%, excuse me, on certain automobile rentals. Automobile rentals are commonly taxed. Just about every state, frankly, even the states that don't have a sales tax, often have, if they don't have a state tax, they'll certainly have a local tax on automobile rentals. States believe this is the way they can export their tax to tourists. And any tax you can make somebody else pay is a good tax, I guess. They expanded the state sales and use tax to charges for transient guest accommodation in sleeping room, cottages, or cabins at a residential location. So what they've done is they have expanded their sales tax to the world of vacation rentals. Becoming a relatively common thing. It's with the huge success of Airbnb and VRBO and HomeAway. State legislators and municipal and city elected officials are looking hard at how you and I now use our extra room or our extra house, and it's not uncommon at all to see legislative bodies at the state and local levels expanding their lodging tax, expanding their hotel tax to include vacation rentals. They adopted click-through nexus, and for those of you that don't know what that is, it's not the latest attempt. But it's a relatively recent attempt by states to get around the Supreme Court's prohibition against them imposing their tax on out-of-state retailers. Twice, first in 1967 and second in 1992, the United States Supreme Court said that a state does not have the legal right to impose its sales tax collection obligation on a business unless that business has a physical presence inside the state. And since 1967, when the first case was issued, the states have been trying to define physical presence, and they've been trying to define physical presence in a way that expands what it means. You know, the Supreme Court was pretty clear that if the physical presence meant you had to be there, you know, you had to have a store, you had to have employees. Well, there's lots of ways to be inside of a state other than having a store or employees, and over the years, the state and industry have argued about what those additional things could include. And a few years ago, New York came to the conclusion that if you are, and I need to use an example to make this make sense to me. Let's say you're the Boy Scouts of Buffalo, New York, and the Boy Scouts of Buffalo, New York have a website, and they, on this website, they put all the Boy Scouts activities and all the things that parents and Boy Scouts want to know about the Boy Scouts, and they also host other people, links to other people's websites. And several years ago, there was a marketing concept that was created. It's called an affiliate program. And under this program, an out-of-state retailer will go to an in-state entity, Boy Scouts of Buffalo, and say, hey, if you put a link to our website on your website, and you encourage the people who come to your website to click on that link, our link, and to buy things, we'll give you a commission. And the state of New York said that when the Boy Scouts of Buffalo are actively encouraging the people who look at their website to to click on those websites and to go out there and to buy things, knowing that when that happens that they will get paid a commission, that in that situation the Boy Scouts of Buffalo are an agent for that out-of-state retailer, and that agency relationship creates physical presence, requiring that out-of-state retailer to start collecting sales tax. This it's called click-through nexus, because that's what you do. You click through. When you click through and you go to somebody else's website and you make a purchase, and that company gives the other group a commission on that sale, that's why it's called click-through, because you click through the other company. This is, I wouldn't say this concept is sweeping the United States, but I think Louisiana is either the 19th or the 20th state that has done that and has adopted that legislation, and there will be more that do so. There probably will be more so that do it this year. So what happens when this happens is that those companies, those out-of-state retailers that have these affiliate programs where they pay a commission to somebody, they usually just cancel. And that's what Amazon did. Amazon immediately canceled their affiliate program in Louisiana, and I'm sure Overstock.com did, and several others who are, mostly web-based did as well. Other sales tax change that they did was to repeal a scheduled 1% reduction of their sales tax on interstate and international telecommunication services. They had previously taxed that at a lower rate than the normal rate, and it appears to me that they were trying to slow heal it, 1% at a time over years, and they have repealed the latest reduction of that. Another sales tax change that Louisiana's made, they usually have 3 holidays. And if you know anything about sales tax holidays, frankly, they're mostly a southern phenomenon and frankly southeastern phenomenon. You don't see them in the west, you don't see them in the Midwest, you don't see them in the Northeast. They're truly a southeast phenomenon. And Louisiana had 3. They had a hurricane preparedness holiday in May, they had a general sales tax holiday in August, and they had a Second Amendment tax-free holiday in September. To save money, and there's lots of theories and opinions about the utility and usefulness of a sales tax holiday, but the one thing that they're really good at is reducing sales tax collections. They may not do much for marketing, they may not much do for equity, they may not do much to make your sales tax less regressive, but one thing they're guaranteed to do is reduce your sales tax collections. Because if you have a period of time when nobody's paying sales tax on something, you have a period of time when no one's paying sales tax, and your sales tax collections definitely go down. So they're actually a relatively efficient way to reduce a surplus, simply because they're efficient for the state because the retailer has to do all the work. So for the May Hurricane Preparedness Holiday, that's gone for this year. They suspended it altogether. So far, it's still on the books for next year, but it won't be a complete sales tax holiday. It will be a sales tax reduction. So if you're a retailer, a sales tax holiday, going from 5% sales tax down to 0% sales tax is about the same thing as going 5% down to 3%. You know, it's just a rate change. The August and September holidays, the general sales tax holiday in August and the Second Amendment holiday in September, will continue, but they are going to be at a discounted rate instead of a full exemption. So instead of someone paying 0 or 5%, depending on when the weekend is, the rate will be 3% during those. And then those will all start back up again in the normal pre-2016 back again in 2018. Other things that Louisiana did, they didn't, and I'll tell you right now, I did not include any of the corporate income tax stuff in here. There is a long list of corporate income tax changes, and they are so outside my level of understanding. I'm a sales tax guy, that I would not have been able to explain them to you. I could have listed them, but I would not have been able to explain them to you. And corporate income taxes affect businesses so differently from each other that it's really difficult to explain them. But what else they did was they increased the cigarette tax by 22 cents per pack. That's a relatively common thing that's been happening in the last few years. During the recession, most states, if they didn't raise their their excise taxes on cigarettes, they talked about it. I wouldn't call it an easy thing to do, but there are a lot of states that have raised their cigarette taxes in the last few years. They increased their excise taxes on alcohol, and I've listed them all here. I didn't list them here to explain them to you. No, I didn't list them here to read them to you. I listed them here so that you could have an understanding of excise taxes on alcohol. We have a constitutional amendment that prohibits the sale and consumption of alcohol in this country. And, you know, just a short few years later, prohibition is repealed. Well, when prohibition is repealed, it's replaced with immense, extensive regulation on the sale of alcohol. Unbelievable regulation of alcohol, and it's all done at the state level. So the one area in the United States Constitution where states have extremely explicit and broad authority is over the sale of alcohol, and it came from the repeal of prohibition. So when states started imposing taxes on alcohol, and the thing that the little chart that you see in front of you is a relatively common chart from state to state to state to state. Most states made the decision that they would start taxing alcohol based on the amount of alcohol. So you see all those, that list there is a list of different types of alcoholic product, where the amount of alcohol varies from product to product to product. And that's why you see different, and if you look through most state laws looking for how they tax alcohol, you'll find a chart that's very much like that. Now, one thing that got compressed down here is malt beverages, beer. It's fairly common, and it was in Louisiana, that low alcohol beer, 3.2% or less, had a lower excise tax rate than higher alcohol beer, which would make sense if you were going to tax beer like on its alcohol content versus others. The historical fact that makes this interesting is that during the Prohibition, somebody made the decision, I think it was Congress, made the decision that 3.2% beer was an alcohol, and that was the beer you could buy. So it's really common to go out there and look at a state, and there was a time when you couldn't sell beer at more than 3.2% alcohol. So I said I included this chart in here not because of what Louisiana did was unusual, because raising excise taxes on alcohol is a relatively common thing when you're short of money. Just so I can show you how this thing looks compared to other types of taxes. Okay, what didn't Louisiana do? Well, in recent years, starting back in, this is 2016, so starting back in 2012 and 13, there was a movement across the country to broaden, to change state tax structures so they're less reliant on income taxes and more reliant on sales taxes. And 7 states, including Louisiana, debated very seriously debated, I don't know if serious legislation, but very seriously debated legislation that would significantly broaden their sales tax to include services. And to do it for 2 reasons. One, make the sales tax more closely resemble actual consumption. You and I, if you look at the charts of historical charts of how much of our economy was represented by tangible personal property versus services 40 years ago, and today we'll see a radical change in how we consume. A much less percent of our consumption, you and mine, our daily consumption goes for tangible personal property today than it did 40 years ago, and more of it goes for services today than it did 40 years ago. So those states whose sales tax are apply to the same things today as they did 40 years ago tax a much smaller share of consumption than they did 40 years ago. And if you're someone who believes that a sales tax should resemble what you and I as consumers spend our money on, many state sales taxes do not meet that definition. But the second, and the reason most often listed by those 7 states was that they wanted to either reduce or seriously eliminate both their personal and their corporate income taxes. There was a real movement, and none of those 7 states were successful, Louisiana included. They're just like as I told you when I started, states are relatively good at evolutionary changes in their tax structure. They're not very good at revolutionary changes. And this would have been in where that's actually, it hasn't successfully been done since 1965. Michigan passed one, Florida passed one, where they radically changed their sales tax to apply to all services, and within months, frankly, almost weeks of its passage in both Michigan and Florida, it was repealed. So what Louisiana didn't do is they wasted a disaster. I know, and cynical people will say you never want to let a disaster go to waste, and it's often the only time you can make radical changes in a state or in a government of any sort. Well, Louisiana didn't take this opportunity. They made no radical change in their sales tax, even though what they're doing on exemptions is really what I'm about to say bizarre. It's not bizarre. It's really, really unusual. Louisiana is a state that taxes few services. They don't tax any professional services. You know, some repair services, some cleaning services, but there are lots of services that they tax bowling alley, so they tax some entertainment. There's lots of things that the consumers of Louisiana buy that are real true consumption that are not subject to sales tax in Louisiana, and the state didn't take this opportunity to do that. I said the only services that were impacted this year were those that had a specific exemption. And this is a relatively, it's a relatively common experience. Many states have a thing called a tax expenditure budget. A tax expenditure budget is some economist's best guess at the amount of tax that doesn't get collected because the state exempts something. And economists say that if you exempt something, you have made an expenditure of state tax revenue to the recipients of that thing that you've exempted, because you tax everything else. And often those state tax expenditure budget reports become the starting point when a state, when a legislator or a governor wants to make radical changes to their sales tax. Everybody thinks that an exemption is a loophole, and there's some rational reasons why some things shouldn't be subject to sales tax. So it's what Louisiana did this year. They started with the things that they had listed, that they have listed somewhere that were exempt from sales tax, and they just went down the list and tried to check them off and make them all taxable. So in conclusion, one of the things that is happened already in Louisiana is when you repeal a sales tax exemption or an exclusion on a product that is maybe unique, you're likely creating a new tax collector. So so they repealed the exemption, temporarily suspended the exemption for repair of railroad rolling stock. I'm pretty sure that the companies in Louisiana that are in the repair of railroad rolling stock business didn't sell anything that was subject to sales tax. The result of this legislation is they have to get a sales tax license, and they have to learn how to collect sales tax. So one of the things, frankly, the very first thing that happened is that this legislation created a bunch of new tax collectors. Folks who've never collected sales tax before, don't know anything about forms, don't know anything about returns, don't know anything about rates. Huge undertaking for a Department of Revenue, huge undertaking for lots of entire segments of the business community. Merchants who sell a mixture of taxable and previously exempt products and services now have to understand all the changes. It's hard enough to teach your employees what to charge tax on and what not to charge tax on, but now to have that get totally upset. You know, the one thing the legislature said everything is taxable. You know, I can understand everything. If I'm a business owner in Baton Rouge, I think I understand what everything means. They didn't. They still kept that list of 65 things that are exempt. So if I'm a merchant out there, I may now excuse me, I may now have to retrain all my staff on what new things they have to understand. To confuse people even more, they made two changes in this calendar year. So they had the April 1 changes, where they created a whole bunch of new tax collectors and created this huge educational requirement on retailers effective for April 1. And then all over again on July 1, you have to do it again. So you have to understand that everything that was exempt on March 31st, that became taxable on April 31st, has a lower sales tax rate on July 1st. And so you have to have some pretty serious training in there, and you have to hope, if you're a retailer, that you don't lose any staff between April 1 and July 1, so that you have the same people that you trained, excuse me, are still with you when you go through this next July thing. And the last thing, they don't have a balanced budget. They went through all this effort, created all these new taxpayers, and they did not balance their budget. So that is what I have. If we have any questions, I am happy to take them. And I don't see any questions. I'll wait another minute to see if anybody wants to type a question into the question box. It's really hard to say where they'll go from here. Like I said, they still have a rather significant budget deficit they have to resolve for next year. They have to do something. From what I understand, the debate today is further tax changes versus revenue versus expenditure cuts. That is the latest debate that I saw. Okay. The question, will I send out a printed copy of the presentation by email? I certainly can. There's my email address right there. If you want to send me an email, I'll be happy to answer your questions, and including sending out this a copy of the presentation. We did record this, so you should be able to go out to Avalara's website at some point in time and see the recording of this. So if there are no other questions, like I said, please send me, there's my email and my phone number. You're welcome to call me. There's our website and our number to get directly to Avalara if you need information about how Avalara can help you, pardon me, help you understand and resolve the situation that Louisiana has put you in. The key to solving these things is to outsource your sales tax and to automate your sales tax. The less time you spend trying to understand what Louisiana did, the better you are and the more you can spend doing what it is you do, which is making money selling products and services. So thank you very much, and we look forward to talking to you again. Thank you.